This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to another episode of Wealth and Toil. My name is Luke Laretive and I'm here today with the man, the mystery, the Mayor of Hobart, Dylan Pargiter-Green, DPG. How are you, mate?
Mate, I am very, very well. It never ceases to put a smile on my face how you choose to make that introduction. So thank you as always.
I think what's most impressive about it is I make it up as I do it. Like I'm not actually. I don't.
For anyone who's listening that thinks that we premeditate literally anything in this podcast, we are so busy in our actual jobs, and the fact that we actually make money out of this. Yeah, the fact that we find time to do this. And spend a bit of time with each other is amazing in itself. But look, you know, you're a creative genius, Larry.
What can I'm a lyrical genius. Lyrical
genius. Get him on stage, up there with Wu-Tang.
Oh, I could be up there.
Just...
Speaking of Wu-Tang and diversifying bonds...
Cream, look at cash rules everything segue. Around me.
Look at that segue. That is a amazing.
Oh my
segue.
God, that was amazing.
The markets have been difficult, shall we say?
Oh, they've been rough, and you know, I love more than anything a moment in time where something
losing money. I mean,
no. I mean, nobody likes that. But if you've over allocated to fixed interest and cash for the last 6 months, expecting these frothy valuations to come off at some point. You know, prophecies becoming true is never something that you can't have a small smirk about, albeit in a time when markets are falling and we're all hurting a little bit from that.
Yeah, I mean, it was pretty interesting to me after we had a period last year and probably the last 2 or 3 years where everyone's just been shit canning bonds and the death of the 60-40 portfolio, and that bonds don't provide diversification. There was this 1 in 25-year period where bond and equity returns were really correlated. Yet in August to date, we've got Japanese equities down 20%. The Nasdaq's down 7.95%. A balanced portfolio is down only 1.6%, a traditional 60-40, and the Bloomberg Global Aggregate Bond Index is up 5.7% in the month of August. So I don't know.
It'd be a hard time to own bonds, wouldn't it?
Oh, so I'm so traumatized.
We did an episode a week and a half ago on bonds. That's
the value of fixed income.
Topical.
It frustrates me, just the recency bias of people and the newspapers and the media in 2024 is just vomiting sickness, rubbish, 24/7, 365, and the death of the 60-40 and all this stuff and all these knobheads talking about alternatives and all this other bullshit they've been going on about. Like, you can't reinvent the wheel. It doesn't, like, it's not that hard. So
there's a reason really certain things work.
Correct.
60-40 portfolios are no exception to that. The balanced investor rides the waves of a stormy market a lot more.
So if you're a balanced investor and you're dissatisfied with your returns over the last 2 or 3 years because they've been in absolute terms quite low relative to, say, the S&P 500, which isn't even relevant to you, FYI, or it's only relevant to you partially. But I think weeks and months like we're having right now, you should be clapping your hands together that you're invested that way, because it's just saved you. If you're in the Nasdaq and where all the money was made, you'd be down, you know, an extra 6% on what you are. So 6 times as much, or 5.5 times as much. So I think that's it's quite instructive and quite interesting to me. The benefits of diversification.
Yeah. Well, I think, you know, there's lots of interesting things happening I think the sort of panic over the weekend set in when on Friday, we're talking Friday the 2nd of August, my mum's birthday. Happy birthday, Mum. Just so everyone is aware of that. But Friday the 2nd of August.
Important financial information. Yeah, good.
Yeah.
Very good. Value add for the
Send
listeners.
my mum gifts.
Yeah.
No, we had the All Ords fall in Australia 2.1%. And then another big fall on Monday, the 5th of August, 3.81%. Today, it's Tuesday, the 6th of August. I think the market's down again today.
I think it's up. It's been up and down all day. Like it's been there or thereabouts. It's actually up 30 basis points at the moment.
Okay, yeah. Well, it's around flat then. It was down slightly earlier when I checked. But, that's still a good 6% whack over 2 days, which is a fairly big drop. August to date, in a week, it's down 5.24% in total. So, big news. But what does it mean?
Big move for sure.
Yeah, big move, and it'll make all the papers and it'll make the headlines. But what does it mean? What's the underlying? I mean, nothing has changed dramatically in Australia. There's a few things that we're going to talk about globally, but nothing has changed significantly since last week or the week before.
Well, I think it depends on what you're talking about, right? So you can look at certain stocks, and we're in the middle of reporting season for Australian companies at the moment. So, and certainly in the US, there's been companies reporting as well. I would argue that there are stock-specific stories out there where you need to be taking action, both on the upside and on the downside. So from an individual company perspective, I wouldn't make any general comments. I think that reporting season is going okay. It's going okay certainly for us at the moment. But I wouldn't say that about Ordinate, which is down 35% today. But stuff like that is the kind of thing that gets me excited in the morning. So let's
frothy.
Well, we're not the biggest fans of the old Ordinate. At Seneca, we think it's a bit overpriced. So if you want to go read about our Ordinate thesis at the top of the market, just go look on Livewire. You can have a read of that. But the point, I suppose, in answer to your question, Dill, what has caused this level of volatility? And let's be clear, this is extreme volatility. We're talking about the global VIX, the volatility index, spiking to to over 38. It normally trades between 12 and 18. So it's sort of double the normal levels of volatility on the market, which means maybe we would normally see a 1.5 to 75 basis point move down. Well, guess what? We're seeing double those kind of moves. So what's happening? Well, one, there's a change in, I suppose, the Japanese economy, and Japan have really increased their interest rates from 0 to 0.25% for the first time really since they were negative. First time they're above 0 since 2007. So they have raised them once before, but that was from negative to flat. So so this is a significant event in Japanese economics and Japanese monetary policy, and it's a significant event for a lot of global hedge funds. And the reason it's a significant event for global hedge funds is what they've been doing is they've been running a little game, and they've been borrowing money in Japan and then investing it in other parts of the world, and that gives them a lot of exposure to Japanese rates. And the other thing they've been doing is you've been able to go and bet on the price of Japanese bonds going up because the yields are going up in Japanese yen. And that, if you're a US dollar denominated investor, is a free sort of carry on your investment to make money. So these trades are now unwinding, and the quantum of money we're talking about is large. And that is where we've seen the volatility in Japanese equity markets, Japanese government bonds, and in particular in the Japanese yen currency. It has been these flows of money. And while that will take a while to wash through, I think it is largely a institutional returns problem. It's not really there's nothing really wrong with the average Australian equity or the average US equity we don't really have a lot of exposure to Japan. and the economic environment in Japan hasn't changed materially from a fundamentals perspective. This is all about the flows of money. Now, does that throw up opportunities? Yes. Does it throw up ways to make money? Yes. But necessarily, are they things that the average person wants to be kind of messing with? Well, I'd probably say no. It's not for them.
If you're an individual like retail level investor, don't try and play currency against relatively small markets in the world. Just like that's free advice. Don't try and do it yourself because it's real. There's just so many moving parts.
Look, I don't think
strategies.
I don't think there's any advantage to anybody trying to trade currencies. I know a lot of currency chartists and spruikers out there will try and convince you that you can day trade foreign exchange. I would argue that you definitely cannot. So
there is always a bigger fish.
Quickest way to light your money on fire is to chase macro, and certainly to try and day trade it is ridiculous in my experience. But by the by, so anyway, that's point number one. Is what's going on in Japan. Point number two, and we'll make more headlines because people understand it a bit better, is these two data points that have come out from the US in sort of quick succession, Thursday, Friday last week. The first one was the non-farm payrolls. That's a leading indicator of employment conditions. It came in below the consensus expectations for July, and we also saw, as is common with these economic data, revisions to May and June down. So people saying that combined with the Institute of Supply Management (ISM) survey of manufacturing employment conditions, which was also below consensus last week. That the employment environment is deteriorating rapidly in the US and that GDP growth is going to fall off a cliff. The US is going into a hard landing recession and the Fed needs to act swiftly to cut rates. And as a result, we've seen bond yields hit 3.8%. I think they're 3.6 actually now, but really a swift move. They were 4.6 for context literally 3 months ago. So this has been a big shift in the outlook. And these two data points combined have spooked the market, and that is why we are where we are.
So, I mean, I think spooked the market is a very good summary of that. And I think you and I are probably in a similar boat here. You definitely have a more in-depth view on this than from a data point of view than what I'm looking at.
I would hope so.
That is your job. But, a couple of those things, I feel like, it was almost as though everyone had been plodding along for the first 6 months of this year, maybe even just the last few months, blindfold on, happy to walk down the yellow brick road, not really worried about what was, whether or not it had been finished and what was at the end of it, because there's so many economic data points that suggested that things were worse than what they were maybe being represented in the markets. There was so, I think we've talked about this before, but there's such a top end heaviness to American markets, Australian markets, and a lot of that was based on suggesting that everything was rosy under the covers and no one was actually experiencing any pain.
I don't know, man. Like, I think, I think you've raised two issues there, and the first issue, and I'll steal this from TikTok economic sensation Kylie Scanlon. She has coined this term, and don't sue me, please, Kylie. The vibe session, and right, and so what she said, the theory here is that there's the economic data, which in the US, and this is where I sort of think this drawdown in markets is a huge opportunity for people, is the data in the US has been really strong, and we've seen pretty good retail sales, really strong GDP growth, declining inflation, all the good employment conditions really relatively good, and it all kind of going to plan. But the household sector and the punters are struggling, and the vibes are off. They don't have any money. The economy's good. All the data points to it being good, but no one feels good about it. And the sentiment's been really poor. Now, we've actually seen that sentiment pick up recently. And I think, but this dissonance between the data and what we're seeing in the survey data and everything that comes out versus what people are sort of expressing their views on and how they feel about the economy are two really different things. So the vibes are off, and that's where the vibe session, like a recession, but a recession in vibes. And that's where this very cute and good term comes from. I think the other point,
it's like a reflection of the fact that no one's going to music festivals anymore because there's no vibes.
No vibes. Okay, so and then the second thing you've raised is a concentration in markets, and I think when you have a lack, I mean, we talk about earnings breadth at Seneca a lot, which means are all the companies in the index growing, or are just some of them growing from a profits perspective? Well, I think to sort of take the same principle and say, okay, well, we're not talking about earnings now. We're just talking about index composition. The index has been growing, particularly in the US, with a very narrow breadth, and not a lot of companies have been growing, but the ones that have been growing have been driving the heavy weights and have been driving things higher. So I appreciate both perspectives, and it does mean that the broad index is vulnerable to those companies losing favour with investors. But it doesn't necessarily mean that your portfolio has to be, if you're not an index passive investor.
Yeah. And look, this is not at all to say that indexes won't continue to be a steady, long-term accumulation valuable tool in a lot of people's portfolio.
Well, let's just say that low cost and market cap weighting your portfolio is not the worst way to do it.
That's right. And particularly if you're getting started. I think when you've got money in your portfolio, though, these are the moments where having the conversation about why you shouldn't be in an index is very valuable. And an example being a 60-40 portfolio where you've got the right weights in there. You said that at the start of this recording. It is so true. And like I've had in the last 24 hours, I've had some of the best conversations. I love these moments where clients call and they talk about the allocations in the portfolio, and we talk about what can be done in these moments as opportunities and what has been done to help protect from them. Like telling someone not to panic is one of the most valuable things that an advisor can do. People who go through these moments and run away scared, like losing money is when you capitalize on losses, and not taking advantage of gains is when you miss out on upswings
I think it's a really tricky one to manage for people, because as an advisor, someone says I want to sell my entire portfolio. Well, they're betting the market's going to go down. What are you going to bet against them and say no, it's going to go up, and then tell them to do the opposite? Well, it's a hard position to take if that's how they feel about it, because at the end of the day, if it goes wrong, they're going to be really pissed off with you. So,
and I think, but I also think that's maybe the difference. That's a difference in what you and I do. We're not looking at individual moments for clients and selling whole portfolios. We're talking to people on a 10+ year basis and trying to time that out and back in.
I think it's madness. Yeah, it's madness.
It's impossible. Like statistically, trying to time that day, it's like 1 in 200
but even if you get it
220 or something like that.
Even if you get it right, like you've still got to get you're only halfway home. Like you've got to buy back in, and you've got to get that right too. So I think that's where everyone forgets. But look, getting back to kind of the more the current period, I suppose, and how it's playing out. I think, Dill, like the thing to remember here is it was only like 6 weeks ago.
Yeah, AFR end of June was on like front page of the AFR talking about US GDP, being way stronger than expected. Rates should be going up.
Correct.
We had broad-based media suggesting that the next rate hike in Australia was going to be
we needed to hike rates in Australia. The US was going to have to be hiking rates again. That Chris Joyce said that I think that the Fed was like asleep at the wheel or whatever, and the RBA was all they're asleep. They don't know what they're doing either. So to go from that position at the end of June to the first week of August, we're in a recession. To me, seems like a bit silly. Like that seems like a pretty dumb thing for the markets to do. So personally, I see that as an opportunity. I see that as the market's overreacting to 2 data points when I've got 6 years of data points. I can show you that the economy is recovering, blah, 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 blah. So I don't really buy into this sell-off. I'm certainly not selling. And I mean, we were fortunate that, our monthly inflows come in once a month for, say, the small cap fund. And, we spent all our money on Friday and Monday. So for the month. So, I'm more than happy to put money where my mouth is. But from our perspective, it's just a great opportunity.
Absolutely. So thinking about the areas that's like worth looking at, like what are you guys doing from a specific opportunity set? Are you buying back into some of these big falls that have happened in the higher growth areas, or are you still doing what you were doing before?
Yeah, look, we didn't buy anything new. Just bought more of the same stuff that we've already owned. But I suppose from a higher level perspective, probably more interesting for people. We still think Australian equities look pretty good. We think the $8, could appreciate from here relative to the US dollar, and in the same way that, say, Japan's benefited from a slightly stronger currency relative to the US dollar. I think we could have a similar impact here. That's not good for the miners, but it's really good for some other parts of our economy, and certainly some other parts of the ASX. But overall, the big driver is just going to be this lower risk-free rate. We mentioned bond yields. We mentioned what's been happening there. They've been falling rapidly, and that's going to mean a lower risk-free rate, lower cost of capital, and higher valuations across equity markets. So it benefits all shares. It benefits probably industrials versus resources, more industrials. And I think out of the industrials, the best way to, there's obviously the rate sensitives, which we think are an opportunity for people at the moment, whether that's infrastructure stocks, property, those kind of places, but also small caps. And small caps asymmetrically benefit from lower costs of capital because, one, they only really can source capital from equity markets. They don't have debt as an option because they might not be profitable yet, or they might not have sustainable revenues or a track record of sustainable revenues. And from an acquisition perspective, that if you're looking at buying a company and it's kind of 50-50, well, now with lower costs of capital, it might all of a sudden become really attractive, and those smaller companies end up being takeover targets. So we think that the small caps is a really good way to play it. Obviously, plugging our own small caps fund, which is doing really well at the moment, but there's lots of other good small cap managers out there as well. You should certainly take a look at. And I think that index investing in small caps is one of the worst things you can do in Australia with your money. So if you want to go through that another time, we can do that. Final one deal from me is emerging markets. They benefit from declining risk aversion globally and a declining US dollar relative to most other currencies. So because they're generally net importers. So I think emerging markets is the other area that people really need to focus on. So Aussie equities just in general, but smalls in particular, and industrials out of the resources, industrials kind of barbell, and then emerging markets as well from a global equities perspective. Like I said, bonds are doing great, but they haven't really sold off. In fact, they've gone up 5 or 6% in the last, this month so far. So, whilst the opportunity still is there, I still think that yields can go lower. I don't think they're going to go a lot lower than, say, 3.2 on the US 10-year. I think that would be about the bottom. So for now, anyway. And if they did start to get lower than that, I would be starting to think, shit, maybe that growth is really slowing down. Maybe we do have an actual problem here, and I would change my view. But at the moment, it's kind of everything's kind of within where I would think of as sort of like target band and steady as she goes type stuff.
Yeah, well, it'd be interesting to look back in 3 years from now on how those sort of diversified bond funds perform, because I think that there's a pretty comfortable sort of yield and growth story there that'll.
And you're not going to see it straight away. I mean, these things, you're going to see these. This will be in the September numbers now. But a big shift in bond yields favours duration, and I'm just really glad that we've been heavily overweight duration strategies in our two income, aggressive income and a defensive income, and I think that's going to mean we've got some really really nice returns coming through for August for those particular products. So yeah, look, we've been sort of on this story for a while. I mean, you've only got you can go back probably a year, and I've been talking about declining bond yields as a trend. It's been a trend, but it hasn't been so pronounced and obvious. I think this has been a real catalyst for the bond markets, and I think what everyone's missing here is that the catalyst for the bond market is often a catalyst for the equity market, and the bond market often leads the equity market around.
And it's because, unlike the very recent event where equity markets and bond markets were correlated, which is very unusual, they are usually uncorrelated.
Like it never happens. Like it's never happened again in your lifetime. Unusual statistically. Yeah.
But there's that recency bias hitting us once again. It's bonds are no good when equities. But go down. They're no protection.
It just shows you, right? Like I'm not saying that bonds are the great diversifier. I'm not saying they're not on a pedestal over there. I just think they're relevant, right? They're relevant. They serve a purpose, and it's not necessarily because they generate the highest returns. They generate positive returns when other stuff doesn't do a positive return. In the same way that defensive alternatives can provide similar sorts of negative correlation, particularly if you're looking at liquid alts like what we do. So I think just important to remember that and not get carried away. When, if the AFR writes the 60-40 portfolio is dead on the front page of the paper, you probably know it's not. That's probably the bottom. You should be buying bonds. And I reckon I might run an analysis just on that. So, and just have a look at the numbers from when the AFR called it a while back. So, look, anyway,
I'm very much looking forward to seeing that.
Look, I'm a vindictive bastard, if nothing else. So, cynical and vindictive.
Last probably question. What do you think that the sort of rhetoric around everything's going into a recession and things, and regardless of how long it lasts, but what do you think it means for some of those infrastructure and property type asset
get
like
long. You need to get long, Dill.
You need to get long.
That is good news for anything that is priced on the risk-free rate. So anything that's got debt is geared to the eyeballs, like a REIT or a toll road or a rail road or a port they're all lovely, lovely, lovely investments during declining bond yields. And in particular, if you wanted to buy something that was sort of like a bet each way, if you said, okay, my views are the economy is slowing and there is an increased risk of a recession. Now, this isn't my view, but I understand this view, right? I'm not saying this is a dumb view. I'm just saying this is not my view, but if you make this argument, you're not a moron. And so you would say, okay, I think there could be a recession. It probably won't happen, but there's more risk. What do I buy? Well, what you would buy is you would buy these infrastructure style assets and these property trusts. And the reason you would buy those, and you would look for tier one assets, and you would look at ones who have got a reasonable growth profile and decent access to capital markets. I'm not talking, you don't just throw the rules of investing out, with baby out bathwater here, but because these are good investments for two reasons. Often, infrastructure has inflation indexed increases built into the contract structure. Often REITs have contracted annual increases in commercial rents. And in the event that there is an economic downturn, you still have to drive on the road. You've still got to rent an office space. You've still got to store your warehouse goods somewhere. Like, these are sort of core parts of business operations that, whilst they may be impacted, they're going to be a lot less impacted than a retailer or someone selling alcohol or whatever, right? It's a less sensitive part of the economy. The revenues that don't grow quite as quickly as some other parts of the more cyclical economy, but these are defensive streams of cash flows. And as a result, whether it's a gas pipeline, a port, a railroad, a toll road, and to a lesser extent, like a data center, which I don't necessarily agree is infrastructure, but it's by the by. These sort of
physical
assets,
asset though.
Yeah, physical asset, real asset. These can be interesting things to have in your portfolio, and certainly, we've got infrastructure and property exposure across almost everything that we do on both sides of the debt and equity on the balance sheet. So, I think that they're good things to have exposure to at this point in the cycle. I wouldn't have said the same thing, 2.5 years ago, but right now, like, rip and run.
Let him go, mate. I think that's a good time for all of us to go and rebalance our portfolios as per Mr. Larative's instructions.
Don't do that. Book it. Why don't you book in a time with Dylan or I, and we can have a nice little long chat about your specific circumstances.
About why the 60-40 portfolio is not dead.
Well, even if you're a 70-30 or an 80-20 or a 30-70 or whatever, it doesn't really make it. The point is that bonds do serve a purpose in the portfolio. Refer to our recent fixed income specialist Wealth and Toil episode, and try not to get caught up in the hype, and just take a step back and remember that we were talking about rate hikes only 6 weeks ago. So I don't think the world's going into global recession, or the US is going to dive into recession on the back of 2 bits of very modest employment data in my relatively wide and deep and long history of reading about this sort of stuff. So I wouldn't get too caught up in it.
One swallow does not make a summer, and one data point does not make a recession, mate.
I don't know what that analogy is about,
just get around it. All right,
I'll just leave that to the mayor of Hobart. He knows what he's talking about down there. That fresh country air is going to your head.
That's good. Well, I'm going to go and read up on what non-farm payrolls are specifically, and stop reading the AFR.
It's worth knowing.
Data points. But no, thank you as always. That was very informative. It's pretty rare that we do a time-sensitive episode. So if anyone's listening to this today, in 3 months' time, sorry. I'm
sure the comments will be slagging me off when I'm always wrong, but that's all right. All right, mate. Have a nice week. I'll
have a ripple
speak to you later.
We'll see you later. Bye.
See you guys. Bye.